This is a bit of a bruising CPI report.
There are certain aspects of this report which push the numbers higher.
It's not good news. We would have preferred to have seen something a little bit less than that.
That last mile of getting down to target after rapid deceleration is proving to be a little bit chewy.
There's a lot of things that the Fed is not going to like about this.
It does complicate the messaging and the decision making for the Fed.
We now had to punt on rate cuts further a year.
This one comes in at 314.43, by far the biggest it's ever been, going back to record keeping in 1957. So these numbers are hot. Interest rates have zoomed up. These are now representing some of the highest yields of the year by far. None of this should be shocking, and this is a cautionary tale for those, especially Fed speak, continually annualizing 3 and 6 month rates as if it's set in concrete. This set of numbers shows that is not true, and the biggest tail risk of any traders that I talk to seems to be higher inflation.
Coming up in today's show, global financial markets making big moves after inflation report. I'll show you where the increases in inflation are coming from, what JPL is likely to do next, what happens if we get a 70s style resurgence, and a look at all the hottest charts in the market, including Lyft, which is now rocketing up 50% after hours. Hey, what's up guys? Welcome back to the Click Capital Daily Market Show. Hope you're all doing well out there, and what an interesting day on Wall Street. The biggest down day, bearish breadth across the board we've seen in a while here. On the back of that hotter than expected inflation report, a lot of traders in the market were expecting CPI to get down to a 2 handle for the first time in a couple of years. However, it's still holding ground above 3%, sparking a strong risk-off move across the market with no real areas to hide out. Even utilities down really hard, affected by higher bond yields that we're seeing today. Same with REITs. Healthcare stocks were down, same with financials, and the risk-sensitive sector of technology and software semis also came off today. Let's look at the S&P 500, having lost the 5,000 mark today. And just going down to the 5-minute chart, there was a bit of a buy the dip in the last half an hour of trading. We were down at 49.20 before closing just above 49.50, and it was actually small caps hit the hardest with the Russell 2000 down a whopping 4%. Big reversal of some moves we saw yesterday, and now we know why. Option dealers were marking up the VIX a lot more than usual yesterday, given yesterday's market performance. VIX shot up today, almost hitting 18 at one point, before reversing in the last half an hour of the market as we got that little bit of a buy the dip. Big jump in volatility risk premium as well. Option dealers now increasing their implied volatilities over realized, and it looks like we're getting that move up off the base in the 2-year yield, almost getting to 4.7% today. Same with the 10-year, popping up as well above 4.3, and just going out to a weekly chart on the 10-year yield. Looks to be attempting to reclaim that rising uptrend it had lost a couple of months back. And we can see that with falling bond prices, TLT falling today. And so what we're witnessing right now is a repricing in the market. Something we've been talking about for a few weeks here on Click Capital. You can see that in Fed Fund futures pushing out once again, and in a material way today, the market's expectations of when the Fed is going to start cutting rates. Starting off the year, they had 80% chance they were going to cut in March. Then they pushed that out to May. Now they've just pushed it out again to June. Market forecasting the Fed to stay on hold the next 2 meetings. Now given about a 73% chance they're going to cut in June. However, we keep getting hot inflation data and other economic data. They're going to keep pushing it out further and further. That's causing a bit of volatility throughout the markets. Even some of these hot stocks like ARM Holdings down almost 20% today. However, the strength in Super Micro persists. Actually finished up 2.3% today. And just looking at all the Magnificent 6 stocks, they all finished down a little bit here today as well. And so stick with me today because I'm going to come back to the charts a bit later on, and we're going to look at whether this is a buy the dip or get the heck out of there type of price action setup. And I'll show you some other things I've found out there. First, let's just take a look underneath the hood of inflation and what's driving this increase, helping to keep it a bit sticky here. So year over year, headline inflation rose 3.1%. That was higher than what economists were expecting at 2.9%. Food overall is helping the picture, up 2.6%. However, food away from home is up almost double, 5.1%. Electricity is up 3.8%. All items less food and energy up 3.9%. And I'm sure a few of you have noticed your insurance rates going up a lot. Things like going to the vet, medical bills, and other costs around the home are all still on the steady increase. And so now we know why Jay was a bit hesitant on 60 Minutes the other week to come out and say when he's going to start cutting rates, because he knew we're going to get some hot prints. He knew the jobs market was coming in hotter than expected. And so there's no way he's cutting rates anytime soon. That's pouring fuel on the fire, which is the last thing he wants to do. He was around in the 70s and saw the big mistake they made back then. They thought inflation was under control. They dropped rates. It shot right back up. And there's still a lot of inflationary pressures around the world. And the ingredients are out there for it to go higher. I'm sure a lot of you have also seen the price of eating out. Just seems to keep climbing and climbing. And that's not profiteering from the restaurants. They're struggling with rising costs as well and having to pass that on to the consumer. What's really helped inflation come down over the last year had been the fall in crude. But just like we're seeing with CPI starting to hold ground and plateau, we've seen the same thing in the price action of crude oil futures. And so the market's been fixated on the Fed going to cut, getting really excited about that. So it'd be a huge upset if Jay had to about face and end up jacking rates this year. Because we don't see CPI move down to that 2 handle. I don't think Jay has permission to go ahead and cut rates. I think that's kind of what he's waiting to see. Because we've still got unemployment record lows, risk assets at highs, a lot of hot economic data. This is not the environment to start cutting rates in, especially when we've got one of the biggest inputs into inflation, crude oil, holding ground, recently flirting with $80 a barrel. That's thanks to the ongoing flare-ups in the Middle East, where the world still gets over half of its crude, and there are little hotspots all over the place, still waiting for Iran's response after the Western alliance's strike back on over 100 targets a bit over a week ago. And so the Middle East conflict could still spiral out of control. Biden and US diplomats trying to get Israel to dial it back and work out a peace deal in Gaza, as that's what's causing a lot of the Iran-backed militants to fire back. But Israel and Netanyahu don't want to do that. They're still upset. They want to finish the job that they started in the Gaza Strip, and they aren't going to back down anytime soon. And that's not good news for the Biden administration, who wants oil down, inflation down, help his chances of being re-elected, and keep him in office for a second term until he reaches the ripe age of 85. And that's why he's already getting ahead of it and attacking corporations for the increases in prices. So it's no surprise we've got Treasury yields surging after this inflation data. Like I said, we're witnessing the acceleration of the repricing that started a couple of weeks ago in markets. And that's why stocks got upset today. And the thing with a lot of us is we've never lived through periods of extended inflation. We've all been used to the secular bull market, rock bottom interest rates, Fed liquidity, inflation hovering around 2% for the last couple of decades. However, there's an eerie similarity between CPI inflation now, here in the yellow line, following the same pattern that we saw back in the 70s. So this chart's 6 months old, and right now, CPI is just sitting around here, in a similar level to the mid-1970s. And so the Fed saw inflation coming down in 75, 76, and actually dropped interest rates. They think we're all good now, don't worry about it. Well, they actually laid fertile grounds for inflation to shoot up again to a second and higher wave, going into the early 1980s. And so this was a lost decade in stocks. Stocks went in a big sideways range for that whole period, like we can see here in the monthly chart, the S&P 500. It was a lost decade, and even much worse if you adjust for inflation. And so like I said, a lot of people base their expectations and decisions off their own experience or what they're seeing in the headlines. And most of us are kind of just being conditioned that everything will eventually return to all-time highs. Just buy the dip and forget about it. However, what were to happen if we were to get that resurgence in inflation like we got in the mid-late 1970s? Well, there's certain things you can do to not only protect your wealth, but actually profit from a resurgence in inflation. At least diversify and hedge your bets. And that's something I go into in my new online course I just released yesterday. You want to check out Module 11, Economic Analysis of Countries, where I teach you basic economics, how to view the world from the top down, and understand the global macro picture so you can position your portfolios and wealth accordingly. And I also go into detail at the best performing assets in that period and how I've already positioned my portfolio for a potential resurgence in inflation in the coming years, and a reversion to the mean and long-term stock market valuations. And I share with you in this course the specific investments, stocks, ETFs, and REITs that I've got that should greatly benefit from a return in inflation. And so if you'd like to get immediate access to my online course, which you can watch on demand, it's over 12 hours in length, then head on over to my website, clickcapital.io/course, and take advantage of my launch week special. Instead of the normal price of $349, you can get lifetime access for the one-time fee of $199, saving you a huge $150, and you can watch all 25 modules at your own pace. And if you're not sure whether this course is for you, I do offer a 7-day refund, allowing you to watch up to half of the course risk-free. And so you can go in there right now and watch those 2 modules about economic analysis and where my long-term strategic investments are to benefit from a potential resurgence in inflation. And even if we don't get that huge resurgence in inflation, these particular assets that I hold should do well anyway because of their valuations and some structural secular trends in society. So I put the link below this video if you're interested in learning more about that. And like I said, you've got 7 days to watch half of it. And if you didn't find any value in it, I'll send you your money back, no worries at all. Just getting back into the daily show, we've just had earnings come out from Lyft after hours as I speak. And what a crazy moves we're getting in the market. We can definitely see volatility picking up out there. At one point, we were just up over 70% just 20 minutes ago as I speak. Stock closed at 12.15, ripped up to a bit above 20 bucks. And here we are now, back trading down at 13. So they did deliver an earnings beat, better than expected. They saw first quarter bookings of 3.5 billion, beating estimates of 3.46. I think what really got the market moving is they said it anticipates to generate free cash flow for the full year. So they've been struggling with profitability for a bit, and that's what the market was really loving. They came out with earnings of 18 cents per share versus the 8 cents estimated, even though revenue was in line. So they significantly improved their cash flow, and it's gone out to a monthly chart. They came in hot 2019, $87 a share, pretty much losing money that whole time. Got absolutely slammed down in 22 with the rest of those high-flying, unprofitable stocks. It's been basing since then, but we just got up a bit above $20 a share a few minutes ago. Closed today with a market cap of 4.7 billion. And I think a lot of people just wrote them off and were just banking on Uber, which has taken the clear lead with a market cap of 141 billion, and the market kind of front run their move, being added into the S&P 500 index, and it's been on an absolute tear for the last year and a half. So how worried should we be about this hot CPI report? Is it the start of more things to come, or is the market overreacting like some analysts are thinking? With some saying a big part of the monthly increase was shelter and categories with typical start of the year upticks, and inflation will continue sliding lower in the next few months. That's an analyst from BlackRock who said, I think the story is still in the near term that we're going to see inflation trending down. The market's overreacting. That has been a story for the last 18 months. So just looking at the headline inflation rate year over year, and what makes up that is food, 14% of the weight, energy, 9.3%, commodities, less food and energy, 19.4%, and services, fewer energy services, 57%. And so there's a yearly chart. We just got the second biggest beat in a row we've had over the last year, and it looks like the downtrend is kind of flatlined. We actually got a hotter print than what we got in July of last year. There's a look at the 3-year chart, the 5-year chart, and just looking at core inflation rate, which is consumer prices for a basket of items, excluding volatile food and fuel costs. And there's a 1-year chart, it too having the biggest beat on consensus over the last year, and the biggest beat since September 22. And there's a look at the 10-year chart of core inflation, still almost double the Fed's target of 2%. Like I said, there's no way Jay's cutting anytime soon. And now we understand why he was kind of hesitant to say that recently as well, and why he's not out there declaring victory on inflation. He learned his lesson from telling everyone inflation was transitory back here when we just popped up for a little bit. And so just going back to headline inflation at 3.1%, that includes food and fuel, energy, which like I said with crude has come down a lot since this time. It's actually a really strong correlation with that, which you can see in this long-term line chart here of the inflation rate year over year in the blue line, overlaid with the price of crude oil in the orange line. Inflation shot up in late 2020 into 21 to early 22, just like crude oil did. Crude oil pulled back, so did inflation. So back to the long-term chart of core inflation, which excludes food and energy. That's already tracking at 3.9% today. Can you imagine what happens if crude shot back up when we've already got inflation excluding it hovering around 4%? And there's a look at the daily chart of crude oil futures. And it's no wonder we've got Biden and his team trying to cool things down in the Middle East. This is a leading inflation indicator. If this pops up above $80 in the coming days and weeks, that's going to drag CPI inflation with it. Not to mention we've had the price of agricultural commodities have a pretty good rip this year as well. They're the primary cost inputs into food. Not to mention the rip up in shipping and cargo rates from everything going on in the Middle East. Another big primary cost input into many of our goods and services. And so if all these things keep going higher, there's a couple of months or so lag on CPI, we could see it tick up above 4% again, which would upset markets a lot. However, that's not changing the view of a lot of analysts and research firms out there who are even admitting stocks are in a bubble and that they will keep inflating until 25 and push the market 30% higher. That's Capital Economics, who said the stock market is in a bubble, but that doesn't mean investors should sell their stocks right now. Their end of year 2025 forecast is 6,500 on the S&P 500 because they think the valuation is going to reach a similar level from its peak during the dot-com mania. Even one of the street's biggest bulls, Fundstrat's Tom Lee, says the stock market's craze for AI isn't a bubble because there's huge demand for the tech amid a shortage of workers. Even though these tech firms are laying off workers left, right and center, apparently there's still a shortage. He still predicts the S&P 500 will climb to 5,200 this year, and optimism is still running hot in the market, with Bank of America research saying investors are the most bullish they've been in 2 years as they still pile into tech stocks. And for the first time in 2 years, investors reported they do not expect a recession recession. And with bullish bets on NVDA and other large cap tech stocks, they're in the most crowded levels in the past year. And we can see that in the skew of call options increasing. Basically, and like I showed you guys yesterday for some of these hot stocks, really steep skews for out of the money calls. A lot of people betting on higher and higher prices. And we can see that again today in options data. A lot of people buying the dip. It was a busy Tuesday trading, 46.2 million contracts traded. Still more people pile into calls at 54%, with over 56% of options expiring in the next 5 days. And just look at some of the notional call option volumes we're getting. 2.19 billion in NVIDIA, more than double that in the S&P 500. Super microcomputer with a market cap nowhere near all these other stocks. Still almost 3 times as many people buying calls and puts. Even with ARM pulling back today, more than double the volume in call options. Same deal with MicroStrategy, Coinbase, Planetaire, and other stocks like that, all ripping up. People loading into call options. That's spilling over into the crypto space as well, with these new crypto ETFs exploding in popularity, pulling in billions in assets under management in just their first couple of weeks of trading. Now apparently crypto ETFs own 3.5% of all Bitcoins in existence after 10 years of pent-up demand. And so even though Bitcoin's been around for 15 years, a lot of people are still banking. It's the currency of the future. Governments are not going to mind that it overtakes fiat currency, and it should become the first only currency in the history of mankind to continue appreciating at the same clip it has been doing for the last 10 years. We can see that in assets under management for the biggest of them all from BlackRock, 4.18 billion, and with Fidelity and others not too far behind them at all either. Just looking at the daily price of Bitcoin itself, just hovering below $50,000 a coin, and there's a look at the monthly chart. All-time highs, 69,000 back in November 21, with a total market cap of Bitcoin just under $1 trillion. And the stock market's no longer extremely greedy, it's only just greedy at the moment. Fear and Greed Index at 69. Are the corporate insiders right? And all the selling they've been doing over the last couple of months, way more than the buying, selling into all the strength in the stock market. Well, it's still yet to be seen on the S&P 500. Can't really call it even a short-term downtrend until we take out the 50-day VWAP, which is currently at 48.48. Did look like there was a bit of a dip by the last 30 minutes of the session today. However, there was a bit of bearish breadth. We can see that in my sector trends table indicator. 24 sectors out of 25, now underneath their 5-day moving average. Surprisingly, Global Jets Airlines holding up the best there. And so it's a little bit hard to decipher a conclusion from this price action today and of late, because we have been having a rotation out of defensives like we've seen with utilities, still pretty weak, along with consumer staples, and we had been seeing a rotation to growth. But remember, underneath the hood, the stock market has been correcting this whole year. We can see that in the amount of S&P stocks above the 50-day average. Starting the year just below 90%, here we are today, only about half of stocks above their medium-term 50-day average. Definitely looks like VIX and volatility's woken up here, broken out to multi-month highs, even though we pulled back late in the day. Going back in history, when we do get those shifts in volatility, it always starts with a one-day spike, as we eventually have to break out before we can keep going further. However, the market's not too worried. We've still got volatility term structure, normal contango curve, the higher out, the longer out we go. Option dealers still asking almost 5 points in implied volatility above realized though, so they could be forecasting for some volatility to stay for a little while. Big pop up in skew today as well, 170. Out of the money puts, 70% more expensive than at the money puts. A lot of people chasing tail risk insurance, or it's option dealers asking for a lot more to sell those contracts. It's got high yield bonds breaking down a little bit here today, showing a bit of a risk off mood. What's not good for stocks is a strong dollar index, which we saw rip up today on volume, which gold doesn't like. That stronger dollar seemed to be peeling away again from these all-time highs on volume. Chinese securities weak as well, having a pullback. And what really doesn't like higher rates is clean energy. Just like we saw in 2022, the sector getting slammed down for higher rates, because a lot of the products in the sector are big ticket purchases, solar panels, things like that. A lot of consumers rely on financing to get it done. And so with rates remaining higher for longer, that's hurting the sector, and we're still yet to see whether this bottom's going to hold that we've been working on for a couple of months and forming here. Canada's TSX having a bit of a sharp turn down today. The rest of the world closes a bit earlier than the States, but European indices, saw the CPI print, didn't like it. There's the China 50 index trying to hold ground there. Japanese stocks being one of the best performers this year, and a bit of a turn down in the Aussie 200. Sharp drop on high beta stocks versus low volatility, so we could see that kind of growth rotation into those risky overvalued stocks. That was a bit of a sharp turnaround there today. There's a look at the hot semiconductor sector, pulling back, but looks to have bought the dip, and a nasty turn down for overvalued stocks that Cathy Wood systematically buys. Their flagship fund, ARK Innovation, down 5.6%. Worst performing sector today. Now the high flying sector, home builders down 3%, still above their 50-day, and gold miners really underperforming the underlying asset, down sharply today, along with biotech and even the defensive sectors like utilities didn't escape the carnage. Bit of a pullback in cannabis ETF, now sitting right at its 50-day VWAP. I think this is just a bit of a healthy profit taking. We had been on a huge tear year to date, up over 40%. So all uptrends will have pullbacks and corrections. I'll be looking for it to find support somewhere around the $7.50 level where we've bounced off a few times before, as we're still waiting to hear from politicians and the DEA whether they're going to go ahead and legalize it. There's a look at the price of Tesla, trying to find a bottom here after their big earnings gap down, trying to hold 180. It's been the worst performing large stock this year, really separated from its peers, and what a tear Super Micro has been on. Even amongst this bearish breadth today, it still rose after gapping down. We are getting some of my reversal signals firing off here, indicating it could be potentially exhausted after it's been walking the line pretty much this whole year. Meme stocks got whacked today as well. There's the spread I'm long, BlackRock Bitcoin Trust versus short Coinbase, holding ground there. And looking across these old economy stocks, they all came off a bit here today, with once again JP Morgan holding up the best out of them all. Alright guys, there we are on the S&P 500. Up until 3:30 PM this afternoon, we're having the biggest sell-off this year. It was a bit of a buy the dip in the end there. That hot CPI report definitely shook the market up. And we'll have to wait a few more weeks before we get some sensitive economic data like PCE, jobs report first Friday of the month in March. Fed meets again on the 20th of March. We'll keep getting looks at the jobs market every week on Thursdays with jobless claims. But just looking at that price action and the 2-year government yield, this could be a bit of a bottoming formation here. Haven't taken out this trend line as well. And remember, this is real sensitive to Fed fund futures. And so we're watching this to see if we continue trading up. And can you just imagine if we get back to that 5 handle? Really hard to see the stock market holding up well if that were to happen. It may just be the recipe for a decent pullback correction on the NASDAQ, because even if we did a 50% correction from those late October lows, that would take us down to around 390. On the Qs, and I bet that would change everyone's tune a little bit on the tech trade, and markets have a tendency to overshoot, so we could go further, as there's probably a lot of people piled in this trade. And when things change, you could think of it like a wave forming in the ocean. Hits that crescendo and it kind of rolls over. There's like a fire in the room. Everyone hits the exit door at the same time, and we get that sharp sell-off spike down, which, considering how low the VIX's been for a while, the ingredients are there for a sharp, nasty correction that could happen in just a matter of days. So right now, I think it's a good idea to keep some tight trailing stops. Not so sure about buying the dip here. We keep getting hot inflation data, and I just want to pay attention to the price action in these hot stocks like ARM and Super Micro Computer, because when this thing corrects, it could have a nasty correction as well. So as usual, we'll play it day by day. Keep watching the price action and see whether today's move turns into a healthy 10% correction in the market, which we're bound to get at some point this year. Other than that, that's all I've got for you today. Thanks very much for tuning into the show, and I hope to see you again tomorrow night. Cheers.